Tuesday, after the market closed, Enphase reported their latest earnings report. Of course, all the attention went to Tesla's earnings report. If you missed that, it's going to be in the top right corner. But Enphase did report it was a miss, and even guidance was a miss as well, which means below what the analysts were expecting. Currently, the stock is down only 5%. When they reported earnings, the stock was down even more than 10% after hours. It also has now a forward PE of 29.6 times, a market cap of just under $15 billion. Year to date, the stock is down 18.47%, and the returns since last year are negative 52%. Now, as you can see, with regards to the analyst estimates, which have been revised down already quite a bit, for sales this year, they expect it to decrease around 33% year over year, EPS to decrease around the same, reaching $3, which in my opinion could also be a bit lower. Now, if you look at fiscal year 25 and 26, growth rates still look quite good, right? But in my opinion, we're going to see some downward revisions, especially after the outlook and the comments that management has made, plus also the current macroeconomic environment is not the best, still have high interest rates, not sure how many cuts will happen this year, which definitely impacts a company like Enphase. If we currently look at the average analyst price target, it still sits at $128, representing around 18.65% upside from the price we're at today. Now, of course, as we know, price target change over time. So currently, that's the average number. Now, before jumping into the report, if you enjoy this type of videos, leave it a thumbs up, subscribe. If not, we really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's have a look at the numbers. Revenue came in at $263.3 million. And as you can see, same quarter last year, that was $726 million. So yes, quite a decrease business-wise. GAAP gross margin came in at 43.9%, non-GAAP 46.2% with net IRA benefits. Non-GAAP gross margin at 41%, excluding net IRA benefit of 5.2%. And this quarter, unlike many other quarters, well, this quarter GAAP was a net loss of $16.1 million, non-GAAP net income of $48 million, GAAP diluted loss per share 12 cents, whereas non-GAAP diluted earnings per share was 35 cents. Free cash flow still positive, $41.8 million. So they ended with cash equivalents, and marketable securities of $1.63 billion. Of course, seeing free cash flow still being positive is quite nice, especially for a company that is buying back shares. They tell us here that they shipped 1.38 million macro inverters. That's down 70% year over year. With regards to revenue, so in the United States for this quarter, for Q1 should I say, that decreased approximately 34%, but revenue in Europe increased approximately 70%, which by the way is a good sign for a company like SolarEdge, which has around 60% of its revenue coming from Europe. So that's probably why SolarEdge is reacting a bit more positive today. The decline in revenue for the first quarter compared to the fourth quarter of 2023 was the result of seasonality and a further softening in US demand, while we continue to reduce shipment to manage channel inventory. Now, with regards to channel inventory, they say here that they expect to ship approximately 500,000 microinverters to customers from their US manufacturing facility in Q2. The number is a little less than what they would like, but their top priority is to reduce their factory inventory. They anticipate resuming high level of shipments in the second half of this year. In the first quarter, they also repurchased 332,735 shares at an average price of 126.21 shares for a total of approximately $42 million. That's what I said. It's very nice to see that free cash flow basically covers those buybacks. Then with regards to second quarter outlook, which was also a bit below what the analysts were expecting, so revenue to be between the range of $290 to $330 million, GAAP gross margin to be basically flat quarter over quarter, same with non-GAAP gross margin, so GAAP one between 42 and 45%, and non-GAAP between 44 and 47%. Now, quickly looking at some valuation metrics with regards to Enphase, so forward PE, EV to EBITDA, price to sales is lower than the 5-year mean. Of course, right now. The company is also growing much slower than before. This quarter actually unprofitable as well. So take all of that into consideration. But still, if you look at price to free cash flow in the last 12 months, 25.1 times, knowing that tailwinds are on the horizon. We don't know exactly when, if it's back half of this year, going out of this year into 2025, but definitely we know that rates are going to get cut. The question is when. And whenever that happens, huge tailwinds for companies like Enphase. So of course, for long-term investors, there might be an opportunity here seeing those valuation metrics. Price earnings to growth right now has ticked a little bit higher at 1.79. Looking at the stock right now, it's pretty clear this is on the weekly. It tried to be above the 50 and the 20-day moving average. Didn't work. Now we're sitting at $108.2, which has been the price for, well, quite a while now. Of course, back in late 2023, we had that presumably the bottom right now at around $75, $80 or so. Since then, the stock did try to go over the 200-day moving average or attempt to go. It was pretty close back in December of 2023 and then here in February, March twice. Now, currently, it's pretty clear, right? Currently, there is no momentum, no positive momentum with regards to Enphase, and so the stock basically will reflect that. It can go lower, and if it goes lower, I do think that for long-term investor, that might be an opportunity because, I mean, we've seen it still generates free cash flow. Yes, this quarter was not a profitable one. Has a lot to do with them trying to control channel inventory, etc., but we know high interest rate environment, definitely not the best friend of a company like Enphase. So if it drops below 100, which again, if we look at the graph here, it could very well be, because if we go lower right now, I mean, it's basically in no man's land. We know, yes, there was a rebound here at the start of February, but we can also have a rebound at around $80. I'm not saying it will go that low. I'm just putting out the possibilities here. If suddenly we have some positive comments with regards to rate cuts, June, July, you name it, then definitely the whole market will start to go up and companies like Enphase will benefit from that. So far, thesis is still, let's say, intact, maybe slow down a bit because of macro. But of course, do share your thoughts down in the comment section below. Have you been adding, selling? Let me know down in the comments. If you enjoy this type of videos, leave it a thumbs up, subscribe if you have not, and I'll see you all in the next one. Bye-bye.